Hello investors, welcome back to the channel. So in today's video we're going to be discussing dividend investing and how dividend investing can create a stream of passive income for you into your portfolio at a much lower risk just by investing into the stock market. So I make videos about stocks and just tips and tricks on investing. So if this is something that's going to interest you in the future, go ahead and subscribe to my channel. Make sure you turn on that bell notification button so you get notified every time I upload a video. And let's get on into the video. Dividend investing offers you a stream of passive income for your portfolio basically. Now there are two types of dividend investing that you can do. The first one is going to be dividend growth stocks, which are becoming very popular more and more in the past couple of years because more people are learning about it. Now these are basically stocks that you're going to be holding for like 5, 10, 15, 20 years for sure. You're not going to be selling at all. You're going to be collecting the dividend pretty much monthly or quarterly depending on the stock. And then you're going to keep reinvesting these dividend, that you're receiving from the payout, and literally you just reinvest it back into the stock, whatever, stock you're owning, which is going to be growing your portfolio by, having more shares of that certain stock, which is going to in return give you more dividends, in the future. Now, what I found is the best, brokerages to use for this is M1 Finance. The reason I'm saying that is because with M1 Finance, you can do automatic reinvestments. So as soon as you get the dividend and it hits $10 threshold, it automatically reinvests that $10. Now, also, it's free. You don't have to pay any type of commission with M1 Finance. And then a second one that I also like is actually Robinhood. Robinhood is same thing. There's no commission, so it's free. But the only thing is you can't automatically reinvest. You have to do it yourself. But the only thing I like about M1 Finance better than Robinhood is you can buy partial shares, like fractional shares on M1 Finance, which is better. Like let's say you were investing in Amazon, just an example, it's a $2,000 stock. Well, if you don't have that much money, you can't buy it on Robinhood. But with M1 Finance, you can buy $200 worth of Amazon. So that's why both of those are, top picks for me. If you don't have either one, actually, I'm going to leave a link in the description for a referral for Robinhood. You get a free stock worth like up to $200, and I get a free stock. And then for M1 Finance, you get $10 for signing up, and I get $10 for signing up. Now, the second option for dividend investing is pretty much investing in a high dividend yielding stock. And pretty much what that means is you're buying a stock that has a very low growth, but a very high dividend. So it's paying out more money, but it's not growing. Now, before I give you guys an example of both of these, go ahead and smash that like button. It shows me that you guys are enjoying this video and it helps the channel grow, so I'll appreciate if you guys do that. Alright guys, I'm going to give you an example of a high dividend growth stock, and the stock right now is actually Lowe's. That's the one I'm picking. Now, Lowe's has a dividend of about 2.25% with a 5-year annual dividend growth rate of 21.7%. And so far, this year the company has been doing okay. It's up about 6%, which is lower than the past years, but it's still doing pretty well. This company is constantly growing. This company has been constantly growing. It has increased its dividends since 1961. So it's been, like almost 60 years right there probably. So it's been doing very, very well. They have been paying the dividend out and, while growing at 20% annually over the last 5 years. They have a reasonable PE ratio with about 18.5. Now, pretty much what this means is Lowe's is going to keep growing as a company, and as it grows, the stock is going to be worth more money, and also their dividend is going to keep increasing, which means that you're going to be getting more money for your stock that you're invested in, and you can reinvest that money into the stock again and just keep rolling that money in. So now we're going to be talking about your second option. The second option is a high dividend yielding stock. So this means that you're going to be getting that stock that is paying a lot in the dividend, but its growth is horrible. And the example I'm going to be using is Barnes & Noble. It has a very high dividend of 8.9%. The stock has been on a terrible downtrend. If you look on the graph for the last 5 years, it has been doing horrible. The stock has went from about $15 and it's currently trading around like $6, almost $7 right now. So that's been since 2014. So that's 5 years, and it's lost almost more than half of its value. So you see right there that these are companies that are paying very high dividends, but the growth is horrible. The stock is losing money. So you might be getting that high dividend, which you think is going to make you a lot of money, but the stock is going down. So you're losing money if you combine everything together. That's why you kind of want to balance. You want something that's either going to be steady, kind of like Coca-Cola, or you want something that's going to be a growth stock and it's rising up as you're getting that dividend. Now I'm gonna give you guys a bonus tip. There is like a third way of doing things, and that's pretty much with REITs, REIT. REITs, and pretty much what this is like real estate investing. And the reason that people invest into these is because they have decent, dividends, kind of high, but it's because the company has to pay out about 90%. They have to pay out 90% of their profits to the, shareholders. They cannot keep more than, that 10% that's up there. So this is something that people do, especially if the real estate market is doing decent. Now, if we're like in a recession, or let's say the stock market is like crashing down, this would probably not be a great idea. But a lot of people invest into REITs, and it's very good if you just keep following the news and everything. It's a very good investment, but it's very dangerous. So it's kind of like a high risk, high reward. But in my opinion, it's better than a stock that's trending down and it has no growth. So REITs is another option for you. Now, an example of a good REIT is going to be O, Realty Income. It's actually a stock that I am invested in myself. And pretty much Realty Income is up about 30% in the past year, in the past 365 days, while it's also paying a 3.7% dividend, which is, pretty decent dividend. It's kind of on the higher end, medium risk, I guess you could say. But as long as the, real estate market is good and everything is going well, I am going to keep that, stock in my portfolio. And that's why, REITs are pretty decent. So I hope that this video helped you out in deciding what type of dividend investing you want to, go ahead and do if you're interested in dividends. Personally, I like high growth stocks with a nice dividend. So, the stock's going to keep going up and I'm going to be raking in those dividends and just keep reinvesting and making more money while I'm also gaining profits on the investment itself. So what do you guys think? Leave a comment below. What do you guys think is safer? What do you guys invest in, and what's better in your opinion? I believe that my way is safer, or my pick is safer as a long-term investment. Just have that high growth and keep that in your portfolio. Now, don't forget to subscribe to my channel, press that notification bell so you're notified every time I post a video. I'm going to be posting, every week like I always do. Also, don't forget to press that like button, check out all my other videos on my channel, and I hope you guys enjoyed this.